So I've been managing a 7-figure portfolio for close to a year. And every year, I will make this video on how to invest for beginners in Singapore to really get people started and not be intimidated by investing. But I guess that every year, there will be a lot of such videos and people will ask, why should I even watch this video? And more importantly, why should I listen to you? Now, if credentials help, here's my current background. I was an ex-chartered accountant, graduated with Bachelor's of Accountancy from Nanyang Technological University of Singapore. I've been making YouTube videos consistently since 2021, focusing on personal finance, investing, early retirement, CPF, and credit cards. And last year in 2025, I finally reached my financial independence or Ikigai goal of having $1 million in portfolio. That was 1 year earlier than my original target of age 35. So believe me, I was as skeptical as you when I began my investment journey and also watching all these YouTube videos. So my honest advice to you is that don't trust anybody on the internet. Don't trust any random person, including myself. Okay, go and take your opinions from all these sources and then form your own strategy. Okay, because the only person you can trust is yourself. And most importantly, don't take advice from people who you do not want to become, because they may be very good salespeople, stalkers on the internet, but they are not who you want to become. So everyone has their incentives, and the late Charlie Munger said, show me the incentive and I'll show you the outcome, correct? Including myself. But to be really objective in today's video, I'm not going to include any sponsors, okay? But if you do want to support the channel, I do have a few links that you can sign up and check out the links in the description. That is all. Also, if you want to join a like-minded group of close to 23,000 members talking about personal finance and investing, then join us at Honey Money SG Telegram. We have close to 23,000 members here already. So before I begin any investment video, I always start with the question, why? Right? Why should you even start investing? Why is everyone telling you to invest? I will not give you the direct answer, but I want you to look around at the people around you, your family members first, like your parents, your siblings, your friends, your relatives, all around you. How do they even manage their money? And I'm very sure the common answer will be work for an income, save the cash in a bank, and at best put it in a fixed deposit to generate a very low 1 to 2% returns per year. And you will have thought that they are winning already. But the truth is they are always losing to inflation. Now, this is my third year of doing this investment for beginner video already. I don't need to explain inflation anymore because I'm sure you all feel the effects of inflation. But let's take a look at the statistics by SingStats. We just look at the core inflation, which already excludes housing, accommodation, as well as private transport, which are your car prices. Last year, the inflation rate was only 0.7%. And I know some of you feel that, 0.7% don't sound very high, quite okay. But if you look at the previous year, it was 2.8%. So these are the most recent 2-year statistics, but I'm very sure for the man on the street, you'll hear that you need to account for inflation rate of at least 3 to 4% in Singapore, correct? So 0.7% for last year is indeed a very low number, but we should not use this 0.7% going forward because the average inflation rate of Singapore is not going to be that low. So you think about it, if your cash is safe in the bank, earning you less than 1%, or in your fixed deposit at best 1.5% currently, is it going to be inflation or not? Okay, I don't have the answer for you because I cannot foresee the outcome. But as of the current rates, definitely it's not going to be inflation. Your purchasing power is going to drop. And here is the standard path that most people have towards retirement. For one, they work until the age of 65, which is the standard age of retirement. They save hard for their money and spend frugally, right? So they work hard, they save hard, and finally at the magic age of 65, they retire and stay at home. Maybe they can take care of the grandkids if their children have their own kids. But that is just for the common majority. Do you want to be part of the common majority? Do you want to only start retiring at 65? Or do you want to start retire earlier? I know this may sound very FA insurance advice, but I guarantee you it is the truth. Most people, if they have the financial means and support to retire before 65, they would do it. Why? Because when you turn 65, I assure you, you do not have the energy and the health to be as active as you were compared to someone who early retired in their 30s, their 40s, or even 50s. So back to the question, why must we invest? You see, investment is about protecting your future. It's about being self-sufficient so that you don't rely on the next generation, your kids, to support you, and then having the moral obligation debate that should kids even support their parents. And if you're a parent, I'm very sure you do not want to pass down money problems to your next generation, right? You want to pass on assets, not pass on problems and liabilities. Now, before we talk about investment, I want to focus on what do we consider returns, okay? Because returns is not just on income, it's not just on capital gain, but it's a formula. We talk about total returns, and that is the capital gains plus dividends income plus any FX fluctuation gain or loss. So when we talk about investment returns, we need to look at holistic nature. right? It's not just income dividends, right? You can receive a lot of dividends, but if a stock price is suffering in terms of capital losses, then it's not great. Likewise, even if you have a spectacular year of capital gains, but if the foreign currency exchange works against your favor based on where you're living, then you're not so great in terms of the investment returns. So we always look at the total returns nature. So with that, let's move on to level one, which is the safety net level of investing. Because we are looking at assets that are mainly capital guaranteed, protected by the government, not likely to lose money. And what are some of these investments? So these assets are mainly for capital preservation purpose and may serve a different target audience, especially when you're older, you're retirement phase, then you don't take up so much risk. You just want to preserve your capital because your capital is large enough, right? Then I think these are very good assets that you can consider. Number one is your CPF OA, especially because it gives you 2.5% per annum interest returns. And remember that your CPF OA is fairly liquid. You can use it for housing, investments, and other things that you can use OA to pay for. And if you have no use for your OA, even below 55, you can transfer the OA to SA, especially after securing your housing, your HDB, or your private property. Some people also consider CPF as part of their retirement cornerstone, and that is where your special account is giving you 4% interest is very favorable. So you can either top up your SA via RSU, retirement sum top up, or like I said previously, just perform an OA to SA transfer. But is it really investment if you think about it? Well, some people do consider CPF as the bond component because it is stable, it is capital guaranteed, and it has very solid returns. But if you want to look at other capital protected assets, we have T-bills, we have SSB, right? All these are protected by the government and issued by them. Like the most recent T-bill is around 1.4% per annum for 6 months. And then for Singapore savings bond, the first few years is around 1.4% per annum as well, unless you hold till the end of the period of 10 years. Some people will tell me that they put in high yield savings account or high interest savings account. Are these considered investments or not? Because they do give quite attractive interest rates if you fulfill the terms and conditions and jump through the hoops of requirements. But the truth is that cash in all these bank accounts, I don't really consider them as investments, but I consider them as cash reserves. They are liquid cash that you can use to activate when you want to take advantage of a market crash and enter into the equities market. But more on that later. So we move up the ladder to level 2, okay? Because level 1 is just capital preservation, capital protected. We move to cash management accounts. Okay, some of you would say that a cash management account isn't it giving a very similar return compared to all these capital protected assets? Because if you look around at all these trading platforms like Moomoo, like Longbridge or IBKR, they all have a cash management account feature or something like that, giving you a passive return of around 1 point something percent per annum. So that is quite close, right, to level 1. So why do you consider that a level 2? And to give a specific example, if you look at Longbridge, welcome new user promo, they are offering up to 5% per annum for 365 days, for new users. So that is really to entice people to use the platform and start investing, You don't have to start enter positions, but you need to at least have the cash inside. And for cash management accounts, they usually hold these assets in money market funds. For example, in Longbridge, it is in the iFast money market funds, giving a range of 1 to 1.5% per annum on the Longbridge Cash Plus yield. But that's on the SGD fund. If you prefer to do it in the USD fund, you will enjoy a closer return to around 4% per annum. But that is if you factor in the FX risk, the foreign currency fluctuation, because we all have seen how this USD versus SGD depreciation has gone over the past year. So why do I say that cash management accounts are level 2, even though their returns is quite similar to level 1? For a very important reason, it's because they are the bow. They are the bows to the arrows of your cash. Okay, if we consider your cash as arrows, they will need the bow to be fired. If all your cash and wealth is forever held at level 1, okay, it is just going to be stored in the storage. It is not going to get used one day. It is not used for offense. It is always for defense, right? But if you put it in a cash management account, at least when the time comes where you really want to start investing, you are ready to prepare to fire your bows and arrows. Okay, your trading platforms are the bow and your cash are the arrows. Okay, if your arrows are always stored in the storeroom like level 1, then you will never see a daylight and you will never see the growth. So I would say that cash management account are a level higher than the level 1. So the purpose of cash management account is not really to put cash here long term. Because if you look at the falling interest rate environment, the returns are just going to get lower and lower. But the purpose is really for you to get ready for an attack, for an offense. And that's where we will prepare to move to level 3. And level 3 is passive investing. This is where we really start to take a look at the real investing world. In investment finance, we have a very popular strategy known as the Bogleheads portfolio. So this is created by the founder of Vanguard, John Bogle, and he advocates a 3-fund portfolio, starting with a local fund, followed by an international fund, and lastly a bond fund. This allows you to have some local plus international diversification while having a small allocation to bonds. So if we look at this level 3 passive index portfolio, and if you want to follow the Bogleheads portfolio, for local exposure, we have to look at an ETF exchange traded fund known as the Straits Times Index. And to track the Straits Times Index, you can use this ticker ES3 or G3B. Both of these ETFs are considered low-cost ETFs that tracks the Straits Times Index of Singapore, which houses the top 30 public listed companies of Singapore based on market cap. So that will include companies like DBS, like Singtel, CapitaLand, all these familiar names that you will have heard of. So for the second fund of the Bogleheads portfolio, it will be the International Index Fund. And some of the ETFs that you can look at for international index exposure will be VT, VWRA, or the most recent ACWD. All these are low-cost ETFs. But remember that for VWRA and ACWD, you can only buy them through trading platforms or brokerages that offer access to London Stock Exchange, like Interactive Brokers, which you can scan the QR code here to find out more, but more on them later. Now, for international index exposure, some of you may prefer like the S&P 500 or QQQ Nasdaq 100 ETF. That is fine, just do what you prefer as long as it's diversified enough and has international exposure in terms of different geography for their revenue exposure. Then for the last one, which is a bond portfolio, you can look at ticker A35 or MBH. This is the bond ETF that is listed in Singapore, but some of us may not prefer this bond component and even treat CPF as our standard bond component really. So I would say it is optional. Some people just want to increase the allocation to bonds. Some people prefer to have zero bond exposure. That is fine. What is important is that you really need to determine your own asset allocation, because I cannot determine that for you, because that will be considered financial advice. What I say here, you formulate and you go and research. Then you go and form your own asset allocation on how much to allocate to each fund. It will highly depend on your own comfort and sleep test. And why I say sleep test is whether this portfolio allows you to sleep well, or would you worry about market fluctuations every night or every day? And the best way to invest in such index funds is to always use a dollar cost averaging approach, where you do a regular savings plan, and then every month or every week, depending on a fixed frequency, you invest a fixed amount, like $1,000 per month, and you automate it so you don't have to look at it, you don't have to set up every month, because this will become emotionless, like robotic. Okay, every month it will just take money off your bank account, and then it will just invest it regularly without you having to touch everything. And with this automation, you can go and focus on your other areas of life, like living your life, right? Everyone has a life outside of investing. And the good thing about this year is that during market all-time highs, you invest a smaller number of shares because the share price is higher. And during market crashes, when share price is lower, you invest in a larger quantity of shares. So this is always balanced out, so you don't feel so left out of FOMO, in terms of all this market all-time high and all-time low stuff. And this is the strategy that works best for broad-based index funds, but cannot be said for individual stock pickers, okay? Because a company has a single allocation risk compared to a broad-based fund, which we will move on to talk about level 4, which is active stock picking. This is where people love to handpick their stocks for either dividends or capital growth. And that means having to do your own actual research behind each individual company in terms of their financial reports, their numbers, the managements, news, macroeconomic trends, and any other industry exposures that will affect the stock price. And that basically means a lot of time needed on top of whatever you are doing outside of work, because it is now considered a part-time job or part-time hobby already, because you're focusing so much time, okay, to research on this company, whether it's worth putting your money in. And the process doesn't end after you buy it, because how long are you going to hold this stock for? Or is there a time in future where you have to sell it based on all the recent news? That is where you have to do consistent research over time, and that is a lot of work. So if this is not for you, I really do not recommend people to go to active stock picking unless this is really what they like. Because some people may really enjoy investing and doing all the research, but I guess a lot of people in this world do not. So for a start, if you really want to try stock picking, right, following a Pareto principle or the 80/20 rule, I would say that 80% in a broad-based index fund first, then the remaining 20%, you can use it to try and stock pick. And if you feel that your stock picking skills are much better and generate consistent returns better than your broad-based index funds, then I would say you can increase the allocation to individual stock picks. But of course, that depends on individual to individual. And we come to this debate on dividend versus capital gain. Which one is better? Of course, in traditional finance and theory, one would say that when you're younger, capital gain is more important because you have a lot of years to compound the growth. Whereas when you're older and you're nearing a retirement age, then you can invest for dividends because you may not have that salary and that long time frame to allow you to hold for long periods and surviving the market drawdowns. So textbook answer, when you're young, go for growth. When you're old, go for income. But is that really true or not? I guess the ultimate answer is everybody is different. Some of you may prefer to invest for income at a young age because you like to see all these passive income dividends coming in. Okay, I would say no right, no wrong. And I'm very sure in investing foreigns, you can also see people in their 60s and 70s still holding all the high growth stock counters because they can accept the risk behind it. Now, whether you choose a capital growth or dividend strategy for stock picking, I would say go with the one that you can stick with the most, that you will not exit out of the market out of fear, out of irrationality, and out of all the news that the macroeconomic is trying to make you believe. Because remember that investment is for the long term, and if you cannot hold for the long term, you are just effectively a trader, at worst a day trader, getting in and out of positions within a short period of time and not seeing all these returns compound over time. So having invested for around 12 years in the stock market, what I can really tell you is that these are the market reactions when market hits an all-time high or just crash because of the news. When the market drop or corrects, or some may even consider a crash already, you'll hear all these internet commentators say, drop so little, where got consider crash? Okay, I'm not ready to buy in until it crash until like 20, 30% or 50%, right? So they don't enter, and they may even never enter at all, right? All this time, they have been waiting for that major crash that may never even happen during their lifetime, and they never even start investing. But the same situation in the reverse side, what if the market is at all-time high? Then you still have people comment, hey, the market is at all-time high, you must be stupid to buy at this current level, right? I'm going to wait for it to drop there and buy. Okay? And these are the same people that will never enter the market. So honestly, I would say that don't listen to internet opinions too much. Just follow your own strategy. Just go and do what you are consistent in. Most importantly is that you are not afraid of investing and you are not afraid of losing money in the short term. Because at one point in time, I assure you, you will lose a lot of money and you'll feel very lousy about it. Okay, just like myself a few years ago. But remember this famous quote from Peter Lynch, who says that far more money has been lost by investors preparing for corrections or trying to anticipate corrections that has been lost in corrections themselves. So you own self go and digest this. So let me tell you that if your investment horizon is at least 10 years, all these news and short-term volatility will just look like noise. And if you zoom out, you will see the big picture of where the trend is heading. So after having said so much about investing, what is the platform that I mainly use for my long-term investment positions? That will be Interactive Brokers. And I've been very transparent about this because they give good exchange rates and they offer London Stock Exchange, and that is where I can buy my international ETFs that are very low cost and tax advantage. So if you enjoyed my sharing, even if you're not signing up for an account, please help me to click this Interactive Brokers link or scan the QR code here, because every click counts and will pay a small commission to my business to help support the content that I'm putting out there. So thank you to everyone who has clicked. Or you can also check out my links in the description for the trading platforms or brokerages that you like, so that you can get all the welcome new user rewards to support the channel and get the sign up gifts. Because I know that a lot of you are holding cash right now and they are your arrows. But if you have no boats, you have no trading platform, when the crisis comes, when are you going to start investing? You need to start, right? At least have the account first, open one first, whichever one also can. Just make sure you have one. And please remember that whatever I'm sharing today is just very generic advice and it's not tailored to anyone. So it's definitely not considered customized financial advice, so you should not follow. And remember that past performance is not a guarantee of future results, because at one point, I'm very sure you will lose money. Now in my channel, occasionally I do talk about my own investment strategies and my opinions towards certain situations. So if you're interested, consider subscribing to the channel so you can get more investment insights. If you have any questions about investing, do leave them in the comments below. I'll either do a video on it or I'll just answer it simply off the comments. And if you want to check out my investment strategy for 2026, what am I looking at, then you can refer to this video right here.